Tuesday morning.
Look at that. 7 days since the election.
7 days. Yeah, it's been. Yeah. It feels like it's been 2 weeks. I don't know why. It feels like last week was
we packed a lot of action into 4 days.
Yeah.
So.
Yeah, man. That
really
was a lot
3.5.
Still going. A lot of this action that you're talking about.
Absolutely. Bitcoin above 90,000 briefly, and then not.
It's ridiculous.
So
it's ridiculous.
I saw it this morning. 91.5, and now we're back to 85, which again, $5,000 pullback, but we're still up. I think $5,000 in the last day and a half. So the herd trade is still flush with funds. It seems
the herd. You want to talk about it? There's plenty of herds running wild in this U.S. dollar. I mean, U.S. dollar is
absolutely
up against everything again this morning. I can't find a rough spot. And what's been interesting, Pete, and maybe we go a little deep on this because, okay, we have the full board up here, and you can see sterling down another 50 pips, euro down another 40 pips, yen down another 40 pips, Aussie actually taking part in some of the Aussie's been one of the stronger ones. Right. The commodity currencies have been relatively strong. Aussie's getting hit pretty good. CAD's getting hit pretty good. Swiss franc is holding, and maybe we'll take a look at that in a second.
Should look at, because that's a little bit. That actually an hour ago was dollar Swiss was trading right up near its highs, and all of a sudden some sellers came in.
Well, so
Swiss
we'll get to Swissy in a second, but I do want to start with the biggest mover here, which is the sterling piece in my mind, sterling and euro, because it seems like the greatest damage has been done to these European-based. Obviously, the euro is the euro area, and the pound is UK, all included in the European continent. But UK viewed as different than the euro area, and then Swiss franc as well, different. What is going on that those major currencies are getting hit the hardest off of this reaction? Because even Japanese yen, and we usually group in the Forex space, euro, sterling, and yen as kind of being like, I don't know if you want to call them like the blue chips or like the developed, like super developed economies. And then we group in Aussie, Canada, Mexican peso, New Zealand dollar as being more like, can be more volatile, relatively smaller economies, still developed obviously, but relatively smaller than those big three. Why is the pound and euro, and here I have the pound up, we'll go to that in a second, but euro, I mean, this is a bloodbath. And it's nonstop, unrelenting compared to, just really quickly before you dive into it.
We got 1 day of two-day action, and that was it.
Compared to this Aussie, that's getting hit pretty hard today. But you can see
we're nowhere near those. We didn't take out the post-election lows or those lows we had beforehand. So
back and forth, and this euro and sterling here just getting punished. What is the story that's going on that is causing so much damage to be done to the euro and the pound specifically?
So I think the euro in specific is a little bit there from, again, not to dive too deep into the macro side, but the thinking is that, again, a new administration with much less focus on Ukraine or NATO in general, basically pay your freight or we're not going to protect you anymore. It's kind of, and I don't mean to, I'm not making a judgment.
It's just the way it is.
But it's just the way it is. There's going to be a different dynamic about supporting your, so is the challenge going to come to an economy that's already a little bit challenged within Europe? Germany always had engine. Germany just had a change in leadership in their government. So that is a little bit of disruption. And then the periphery of countries that make up the euro also under additional stress. We're seeing rates go higher, long end rates go higher there, where we're seeing the same thing here. The bonds, the 20 years, the 30 years trade yields higher than the 2 years or the shorter term stuff. They're their bunds, which are their equivalent of their 20-year, trading lower, and the idea that they're going to need to borrow more, their economy is going to be more challenged. They're going to have to pay for more of their own defense, and depending on how Ukraine unfolds, geopolitically, it becomes a little bit more challenging to them closer from an expansion standpoint. So I think all those things are weighing on euro here. A little bit of again, some of those pieces playing through, as well as the fact that pre-election we traded up to the upper end of the range, 112. So where are we? We're through the range, but we've basically just given back. We've given them back basically 7 months worth of work in a matter of a couple of days, 6 days. So to get us right back down to those levels. So it's interesting here is that we're going into the morning here, right on the lows. There really is no. Where are you on a?
That's the daily chart, just showing a little bit of that context that Pete is talking about from the spring until really the election season started to kick off in October, and then you really started to see Trump gain in a lot of the different predictive markets and polls and what have you, and then obviously he wins, and now we're trading through those lows. To your point, Pete, yeah, the journey from 106 to 112 on the upside was a lot longer and painstaking and big developments having to come through of, different periods of, oh, wow, the euro area's, GDP and inflation and employment metrics are maybe looking stronger than the U.S. It's obviously the U.S. bigger economy, but everybody over the course of the middle part of this year is worried about, how is the economy going to take interest rates still being higher than they've been the last 2 decades, really. And we've come down a little bit in terms of, when inflation was 9%, that was teamed with an economy that was really running. And we're talking about, earnings that are going off crazy, stock market moving through highs and everything else. And now the fear in the middle part of this year was, how is the economy going to deal with these rates that are now at these high levels? And even if they come down, they're not going to go down to zero like they've been at for the last decade.
Absolutely.
And we went back and forth between, the euro area is looking stronger than the U.S. The U.S. is looking stronger than the euro area in this kind of come down phase. And now it seems that the U.S. election has totally transcended or maybe made that even tougher for the euro area or shined a brighter light on the fact that you still have 4% plus interest rates. And to your point, the fact that bond prices aren't rising and they're not pricing in more cuts or lower.
The short end is, though. So they're getting we're going to have, and again, we're running a $28 trillion deficit here. So it's not like we're not going to have to borrow a lot of money too.
Sure.
So, but what's playing through now is that combination of effects of they're seeing their long end rates rise, where they, what they're going to do to stimulate the economy will be more of a question. When rates diverge, we see that play through the currencies. We saw that play through yens, with yen at 25 basis points, our short-term paper at 4.5, now closer to 4. But that divergence driving dollar yen. So we're seeing a little bit of that play through here. I think
short-term rate divergence between the euro area pricing in more cuts in the short term because of the added stress post-election.
Yes, and the slowdown they're seeing in their economic numbers. So So the question becomes: if I'm trading FX, do long-term rates differences drive the difference, or is it short-term? It's really the short-term rates are what determine the carry on the trade, or whether you're getting paid or paying to carry that position, or embedded carry if you're trading other products. That's really what's reflective, but there is the market looking at longer term rates. So the math is based on short term rates. The market chooses what it wants. Sure. And I think it's looking at this divergence in what they may have to spend and where they may have to sacrifice to meet those requirements.
I always view it as like tiers, because you can look at every asset class and kind of create, and it's not always 100%, but you can create tiers of what is the most meaningful to that asset class. And so, for example, if you're looking at the S&P 500, right, the first tier is going to be those top 5 or 10 stocks that make up, 20 or 30% of the weighting, and what earnings are doing, what's going on at those companies. Essentially is going to be that first tier, and then maybe the second tier is like interest rates in the U.S. is going to affect the S&P 500, and then after that, maybe it's smaller tangential stuff. With Forex markets, it tends to be more so, and we're looking here at Eurodollar, so we'll stick on this as an example. That first tier is likely going to be short-term interest rates in those two regions, because it's a huge driver of essentially the supply and demand dynamics of that currency. Tends to be more demand for a currency that is in here two relatively stable regions, because that can transcend this first tier that I'm going to talk about in just a second. But yeah, if there is now a market pricing in lower short-term rates for the euro area, and I'm looking at this euro dollar trade, and to hold long euro dollar for that carry trade, I'm going to have to pay more because I'm now financing my long euro position in a short dollar position at higher rates. The short euro dollar position might get more demand, might get more looks because you're getting paid that higher US rate.
And where can you see that?
Well, you could see that here in the platform. But the other, and you can see right now, it's a relatively small amount, but Pete's point being maybe this market is gone from, 112 down to 110 pre-election and now down to 106, with the idea, part of the idea being that short-term rates continue to diverge, and this number,
and that swap bid has moved out recently. So that is taking into account that. So that gives you, again, the swap rate is, and I keep promising, and we will put some content together about this for the show, understanding what swap rates mean and how they impact whether you get paid or pay to carry a currency pair, and why some traders look at that and where the carry is the greatest. So that's one aspect of trading spot FX that's really interesting and differentiates it from product side. Doesn't make it more confusing, just adds another element to it that's interesting. So looking at those swap rates is an interesting way to see that interest rate divergence.
And a couple of things to say on that. One, the swap rate, just like theta in an option strategy, doesn't guarantee you anything.
No.
Because you can be short the euro dollar pair here and be getting your 0.1, 0.2, maybe it continues to climb 0.3, whatever pips for days, weeks, months, and the euro dollar market can be moving higher by 5, 10, 20 pips on average per day.
Absolutely.
And that doesn't create a sustainable strategy. So it can work in your favor. It can work against you if you're long euro dollar. And here, of course, the classic example of the last couple of years is this dollar yen, where the big divergence between short-term rates in Japan being essentially 0%, here in the U.S. still being around 5%, giving you 1.5 pips on a daily basis. Also, these are indicative prices. They can vary from day to day, but the price action is a huge piece. But also that second tier is the geopolitical piece that can transcend any of this. And I'm glad that you brought that up with this euro dollar piece here, because it was completely out of my mind, the Russian-Ukrainian war that's been going on and how a Trump presidency might lend to that versus a Harris presidency. And it seems like, again, nothing has been solved. It's not like this guy was elected last week, and so this is how the next 4 years are going, and you better pile into short euro dollar because it's going to dust. This is just the reaction on the fact that, to your, and I think you use this word, stress. There just might be added stress in the euro area with this Republican presidency versus the Democratic one. And that's what seems to, the divergence in rates is maybe that first tier. That second tier might be the added stress of the war going on relatively closer to the euro area, and as well as a relatively weaker economy that now might be more stressed by U.S.-Euro trade relations not being as smooth as they've been.
Yeah, absolutely. And so the market prices all that. Again, you don't need to be a macroeconomist to trade FX. The market prices that all in wonderfully for you.
The market does it better than the macroeconomist.
Much better, guys. You want it. So they had such an argument about whether those election markets were destructive to the election itself, were they misleading or anything. And we found that the election markets actually were much more accurate predictors of the outcome than what all the polls said.
Yeah, for sure.
So interesting one there. And again, the markets continue to be, now that's a market that's evolving, but the markets continue to be very efficient ingesters and disseminators of all that information. So we take it for what it is, and we trade accordingly. But yeah, this continues to be, short of that one-day rally we saw Wednesday into Thursday, this continues to be a market that doesn't exhibit. And even if we go down, let's go to an hourly, just
This is a rough trade.
this is a very rough trade because you see we had two little basically pauses where the market tried to build a little bit of energy and gave it right back. And we're continuing to do that again. We're rolling over it into the U.S. session on the lows. I think this is going to be a challenging trade right now, whether or not they plumb through 106, and we see that play through. Let's take a look at client sentiment. Where are tastyfx and IG? Okay, here's a market where you would expect this a little bit. Now we're seeing this. Traders are, again, some traders are momentum guys, so they're looking for, I want to see the capitulation. I want to see the break of 106 and see where it goes. And they'll lean into being short on a break to a new level.
Well, and being short, like we talked about, is giving you that carry.
Absolutely.
So,
and now you've got the contrarian guys who are looking too far, too fast. I want to play this from the long side.
And this is what makes this, in some ways, an impossible task. No one, macroeconomist, best trader in the world, Warren Buffett, whoever, knows what the next price of euro dollar will be, 107 or 105. If we're sitting here at 106, let's just call it 106. But what makes it so intriguing, and what's interesting about this being, yes, 69% long, which is overwhelmingly long,
right,
but not 100% long. And we've seen some of these client sentiments historically, Pete, 75%, 80%, 85%. I think we saw short in the yen when we got up to 160.
Yeah.
But the dynamics of this make it so split, even at this extreme, and 69-31 isn't 50-50. But again, I would make the case that it's relatively equal on both sides for a market that's just getting trounced. And
Agreed.
There's a bunch of interesting things to take into account here, because we talked about the carry trade and how maybe there are, we don't know, maybe there are a lot of people in this Forex market that have been short or created new short positions recently because the carry is in their favor, and they think the carry is going to continue to move in their favor. And so they'll be short and take all the noise of, 150,
then I get paid a little bit every day on the trade.
But the other interesting thing, and this is something that you and I have looked at so many times, and it does not, guarantee, it's not predictive of the future, but Forex markets historically are some of the most mean reverting markets of all time. So these guys on the long side aren't necessarily sitting there. You might quickly cross them off by saying like, oh, they're catching this falling knife. Trump is in the White House now. This is going to be different. The U.S. dollar is going to railroad all these other currencies. Well, let's take a look quickly at the historical context here, because we've had a Trump presidency, and during that period, this euro dollar market
120
traded between 105 and 120, and right now we're at the lower end of that range. And also take president out of it, take Trump, Biden, Harris, whoever out of it. Of course, we've had a pandemic, all these different things, and also I should say as a quick aside, there's always something. Like you always want to say, oh, well, you can't really talk about Trump versus Biden because there was a pandemic. Every 4 to 8 years, there is something.
That's why we don't get caught up in it. We talk about context a little bit, and like client sentiment, you're going to talk to half the guys who say, well, the market's always wrong. So those 70% long guys are going to get tested, and we're going to trade lower. Then you get the guys, I want to go with the herd, and I'm going to buy them down. It's just a tool. Again, parse it and move on as a tool in making decisions. It's not, as you said, there's no guarantee to any of this.
But what is interesting is you look at these historical prices. Because you pull up a chart of equities or gold, a handful of these different assets, and you get an up and to the right chart. And what we like so much about the Forex space,
it's a great point,
is that especially when you're looking at major, actually, honestly, pull up a historical, and tastyfx has a ton of historical data on 80 plus pairs here, so you can go crazy. You pull up a chart like this is the monthly chart going all the way back to 1990 for euro dollar. So more than 30 years of data. And you don't really see more than a couple of years in any extreme. And especially the last 2 decades here, Pete, you're trading between, of course, there's the outliers here of when we traded parity for a month or two. And there are the outliers here where we traded above $1.50 for a couple of months. But you're, for the most part, really trading in this 110 to 130 range. And so you have, 69% of that audience. They're maybe they're not saying exactly this, but long and taking that negative swap rate with the idea that this market is likely to mean revert at some point in the future. Right. The question becomes, and the hardest thing for traders, from where, from when, is it going to, mean revert from parity or from 95 cents or from 90 cents, which we got down to in the early aughts? Is it going to happen tomorrow? Is it going to happen next week? How long and for what distance can I hold on to a long position here? And so you might have 30% of those short traders, either taking that carry into account and willing to take the noise, or they're short just for 50 pips or 100 pips or whatever. So many different dynamics, but that's what creates, a two-sided market, an even market that is not able to be predicted.
Absolutely. And I think what's great is, again, zooming out to this monthly is great in the fact we have all this history, gives you context. And the context is the market cheap right now? Yeah, we've given back 6 handles in the matter of a month. That's a big move. That's a 5% move. Usually currencies move 3% on a yearly average going back the last 20 years. But when you look at this, it's like, sure, we're down a lot, but this is why whether we're going to be a contrarian and be long or short with momentum, we're going to put structure around both sides of that trade. If I'm right and if I'm wrong. And that's the important thing here is you can't go through the exercise, it's so cheap, it's got to bounce. It does. We do have a mean reverting aspect to these pairs, which is really nice. But we always set those management techniques. That's really important takeaway. This product or any other you're trading, you've got to go into this with the idea of, when you start telling, the market's just wrong, this has gone too far too fast. The market is the most efficient pricing tool of all this macro stuff that's out there. And when I hear 3 guys over the weekend all tell me, par's coming next, that just drives me to want to be long because whenever anybody makes those calls, but I'm also mindful of, depending on what side you want to trade as a contrarian, you're setting realistic expectations.
Well, and I think that's a great place to end this discussion because at the end of the day, absolutely nobody knows.
No.
And if I learned anything when I studied math in school, when we would come up with all these different models to predict markets. And inevitably, the best way to model a market is expect that the market doesn't really drift in one direction or the other. And it's symmetrical on both sides.
Right.
And when you think about it that way, if you're looking for a mean reversion to the tune of 115 or 120, well, then you better have enough capital and enough risk tolerance to take a move down to parity or 95 cents, because it's just not realistic to say I'm putting my foot in the ground here and I'm saying it's not going to go lower than 105, but I'm going to hold for a reversion back to 120, because you're likely to get a lot of noise in there. Now, if you're looking for just a quick trade up to 107, then maybe you're only looking to take risk down to 105. Right. But it's something to be aware of, and I love that you brought mechanics into it. It just depends on how you're trading this.
Well, and you want to see a little bit of break. Let's jump to the Swiss just really quickly, because we're seeing that is something that's giving us a little bit different view right now. So Swissy, again, remember, this is dollar Swiss instead of euro US, so
inverse.
Strong dollar again, inverse, but very kind of setting the table in a different way, not sitting right at those highs, i.e. Swiss lows, right when we go to the US session. There's been a solid pullback here a little bit. So 30, 40 pips. Are we seeing a little bit of two-way action? Yeah. So this actually, and don't be always necessarily chasing the thing that's at the cheapest extreme. Look at the tastyfx a little bit and see where you're seeing a little bit of two-way back and forth, and that's where you may want to find. And that's what's great about FX. You can find the currency pair that's giving you the kind of action you like. So you're not having to squeeze yourself into a one-size-fits-all product, both in terms of sizing, both in terms of exposure, and both in terms of product. So there's a lot of opportunity within the FX
bunch of
space.
different flavors.
Yeah.
Well,
All right.
Let's hand it off.
Let's do it, my friend. So guys, have a great day. We'll see you back here tomorrow.